All right, today we are diving into one of the most intense, high-stakes battles in the world of state taxes, the residency audit. We're going to get super technical and show you exactly how state auditors can take a totally routine tax form, the Federal Schedule A, and use it as a weapon to argue you never really moved out of their state at all. And look, make no mistake, this is not a simple check-the-box kind of deal anymore. It has become a full-blown forensic investigation. Auditors are literally digging into the tiniest details of your life. We're talking everything from your mortgage applications to your dog's vet bills, all to keep your income on their tax rolls. The stakes, they're incredibly high. So here's our game plan. First, we'll set the stage, what we're calling the jurisdictional battlefield. Then we have to define two really key concepts, domicile and statutory residency. After that, we get to the main event, a line-by-line teardown of how auditors use your Schedule A against you. And finally, we'll talk about how you build a rock-solid defense, which, spoiler alert, has to start years before an audit letter ever shows up. Okay, so let's start with the big picture. You've got a lot of wealth moving out of high-tax states, think New York, California, and heading to places like Florida or Texas. Well, those states are not just waving goodbye to all that tax revenue. No way. They are fighting back. And they're using really sophisticated, aggressive audit techniques to challenge whether you've truly changed your home base, your domicile. Now, to really understand these audits, you first have to get your head around the two different ways a state can legally claim you as a taxpayer. It's not just one thing. It's about domicile and it's about statutory residency. These are two totally separate legal frameworks, and an auditor can use either one to try and tax your entire worldwide income. Let's talk about domicile first. This concept comes from common law, and it is all about your subjective intent. You can see right here from the New York regulation, it's the one place you intend to be your permanent home. That word intent is everything. It's not necessarily about where you spend 184 days, it's about what's in your head. Where do you plan to live forever? But here's the catch. You have to prove that intent with cold, hard facts. Statutory residency, on the other hand, is completely different. It has nothing to do with your intent. It's just a mechanical test, a pure numbers game. It's pretty simple, actually. Did you spend more than 183 days in the state? And did you maintain a permanent place of abode there? If the answer is yes to both, boom, the state says you're a resident for tax purposes, regardless of where your true domicile is. This chart really breaks it down nicely. You can see domicile is all about intent, and the burden of proof is clear and convincing evidence. That's a high bar. Statutory residency is just about the facts, the day count. The defense strategies are totally different too. For one, you're proving you left and landed somewhere new. For the other, you're just fighting over your calendar. All right, so now let's get into the heart of the domicile audit, because this is where it gets really interesting. The auditor's number one weapon, their roadmap into your life, is a document you probably don't think twice about, your Federal Schedule A, the form for itemized deductions. And this right here is the absolute key. There's a huge disconnect. You, me, our accountants, we all look at Schedule A and see a list of deductions to lower our federal tax bill. But a state auditor, they look at that same piece of paper and they see a sworn statement mapping out your entire life. It's an inventory of your homes, your priorities, your financial center of gravity. It's their roadmap to proving where you really live. And hey, don't just take my word for it. This quote is pulled directly from New York's own non-resident audit guidelines. This is from their playbook. They are explicitly training their auditors to comb through your Schedule A to find any little thread that connects you back to New York. Okay, so let's roll up our sleeves and get granular. We're going to go line by line and show you exactly how these perfectly normal deductions on your federal return become dangerous traps in a state residency audit. First up, the home mortgage interest deduction. This is governed by Internal Revenue Code Section 163. The law lets you deduct interest on your principal residence and one other home. Now, that term, principal residence, that's not just casual language. That is a legal definition in the tax code, and you better believe state auditors know it, and they absolutely seize on it. So here's how the trap works. When you get a mortgage, the lender almost always makes you sign a document designating the property as your primary residence to get the best interest rate. So if you say you've moved to Florida, but your old New York mortgage papers still say primary, an auditor will subpoena those records. And now they have a document signed by you that directly contradicts everything you're claiming in the audit. It's a killer piece of evidence. And it is the exact same story with property taxes. That big property tax deduction on your Schedule A, to an auditor, that's a giant flashing neon sign. It points them directly to the local tax records, where they'll check for things like New York's STAR program. That's a tax break given only to a primary residence. If you moved to Florida, but forgot to tell the town to stop giving you that benefit, the auditor's argument is simple. You are actively, affirmatively telling the government that you still live in New York. Auditors will also do what's called a comparative value analysis. I mean, just look at this chart. If you're deducting $45,000 in property taxes for your home in New York, but only $4,000 for your condo in Florida, what story does that tell? The auditor is going to argue that the sheer financial weight, the investment, proves that the New York home is the true center of your life, no matter what you say. Now, you might be wondering, does this stuff really trip people up? Oh, yeah. Let's look at a real-world tax court case, Hof and Ochrehof. They tried to change their domicile from New York to Florida, but a single checkmark on a state form became one of the key pieces of evidence that sank their case. So here's what happened. On their New York non-resident tax return, on this form IT-203-B, they checked a box, a little box that said their living quarters in New York were still maintained. That one little piece of self-reported information directly contradicted their entire story about leaving the state for good. And the court used it against them. It just goes to show. Every single line on every form matters. Okay, so hearing all that, the obvious question is, how on earth do you defend yourself? Well, you need what's often called the kitchen sink defense. You have to throw everything at it. You have to prove not just that you left the old state, but that you truly landed in the new one. And that requires an overwhelming mountain of evidence. Your file of evidence has to be deep. We're not talking about one or two things. We're talking moving receipts showing your stuff left the state, utility bills that show your power usage in New York plummeted while your usage in Florida shot up, even things like vet records for your pets. Auditors call this near and dear evidence and find it very persuasive. And it's not enough just to register to vote in Florida. You have to prove you actually voted there. You are building an undeniable story with facts. And all of this brings us to what is easily the most important point of this entire discussion. You don't defend a residency audit after you get the notice in the mail. That's too late. The real defense has to be built years in advance. It requires a proactive fortification of your entire life. This right here is the critical mindset shift you have to make. You have to stop looking at your federal Form 1040 and its schedules as just an annual chore to get done. You have to start seeing it for what it truly is to a state auditor. Exhibit A in a future legal battle. So what does a proactive defense actually look like? It's cleaning up that paper trail. It means maybe you refinance an old mortgage just to get that primary residence language off the documents. It means you formally write to your old town and say, hey, I'm not eligible for that STAR exemption anymore. Take me off the list. It means you shift your charitable giving, your doctors, your accountants, your entire life to your new state to make sure the facts on the ground perfectly match your stated intent. So I'll leave you with this question to think about. After hearing all this, after seeing how an auditor can tear it apart line by line, take another look at your own tax return. Is that Schedule A just an innocent list of deductions? Or is it, without you even realizing it, the state's star witness in a future case against you? The answer to that question could be worth millions.